Some people believe technical analysis is financial astrology, perhaps because they have only seen the astrologers. But a chart does not need to be prophecy to reveal something real. A chart does not predict the future. It records what the market did when it was placed under pressure. I observe, not instruct, for educational purposes only. Bitcoin. From June 2019 to July 2021. We are looking at the weekly chart, and for the first time on this channel we will also look at volume. In this chart we will observe three psychological traces: fear, memory, and greed. Let us isolate the first fragment. Before the panic there was a structure. Bitcoin was moving inside a descending diagonal. There was order, there were limits. There was a region where the market seemed to accept the movement. Then came the week of March 9th, 2020. A candle pierced the structure downward. Volume appeared in an abnormal way, more than 3 times larger than its own average at that moment. This does not tell us exactly who sold. It does not tell us who was forced to leave. But it tells us that participation changed in nature. Usually we cannot know with certainty whether what we see on screen is panic. But some moments are difficult to confuse. March 2020 was one of them. And panic leaves memory. Not because the chart remembers, but because people remember. Those who bought before remember the pain. Those who sold during the panic remember the regret. Those who stayed outside remember the opportunity they missed. Observe how price returns to the breakdown region and remains there for some time. The old failure becomes a decision point again, not by magic, by memory. Then, behavior begins to change. A new diagonal structure is born, this time ascending. Price begins to rise above the past structure, and volume begins to show signs of strength again. Not every week, not perfectly, but with enough spikes to show that new participation was present. Then price breaks an important resistance. A region that once limited the movement is finally overcome. The market is not only reacting, it is beginning to recover intent. After memory comes greed. A new ascending diagonal forms. At the beginning, the movement rises with strength. Price advances, volume follows. There is convergence, there is participation and intent, but then something changes. Price continues making higher highs. The channel still points upward, but volume begins to make lower highs. Participation no longer follows with the same enthusiasm. Now let us move forward in time, because a single example can teach, but repetition begins to reveal behavior. The market does not repeat prices, it repeats behavior. After the top, a new structure appears, this time descending. A classic bear market wearing a bearish diagonal. During this period, abnormal volumes appear near bottom regions. Price tests important zones. Volume expands. And again, we cannot say with 100% certainty what each participant felt. But the structure had the smell of capitulation. The first major mark coincided with the collapse of Terra and Celsius, the second with the FTX crisis. Price was falling, but volume was rising at bottoms. It was another form of divergence, not euphoria but exhaustion, not pursuit but capitulation, and once again the market left memory behind. Price returned to respect regions where pain had been registered. After capitulation, a new bullish structure began to form. At the beginning, price and volume started walking together again. Price was rising, and volume was rising too. There was convergence and participation. When price broke above the old $30,000 region, the reading gained strength. The zone that had once been a bottom fund became a region conquered by the market. It was not certainty, but it was evidence. But this time, the rally was different. It was born from a capitulation region, and it carried fatigue through almost the entire move upward. Price continued advancing, but volume did not follow with the same strength. The bearish divergence was built slowly, not in a single week, but throughout the movement. and the structure only broke much later, in November 2025. That is the point. Price usually speaks last. Before it, many times, the quality of the movement has already changed. Then came a new volume spike, not as extravagant as the bottoms of 2022 or the tops of 2017, but relevant, and it appeared in a symbolic region, the old top of 2021. In 2022, the market was testing the memory of the 2017 top. Now, we are testing the memory of the 2021 top. But there is an important difference. This time, we did not see such a clear capitulation. We did not see the same type of bullish divergence at the lows, and we did not see the same signature of exhaustion. The market reacted. But reaction is not the same as a change in character. So the question becomes inevitable. Where are we now? For now, my reading is that we are navigating inside a sideways range. And when the market enters a range, many confuse pause with resolution. But a pause does not answer everything. It only creates new questions. The large volume that appeared at the beginning of this current movement may be a replica of the first large volume of 2022. If it is, the decline may not have finished its process yet. But there is also a more optimistic reading. Perhaps we are already inside the final capitulation movement, something closer to the phases of Terra, Celsius, and FTX. We do not know yet, and when we do not know, we should not pretend certainty. What we know is simpler. There is still a descending structure being built. We are still in a bear market. That for now is difficult to deny. What we do not know is the final shape of this structure. Perhaps it will be as steep as the one from 2021. Perhaps not. Perhaps this bear market will be softer, less aggressive, less excited. Just like the rally of this cycle itself, a market can fall with violence. But it can also fall through exhaustion, and exhaustion, many times, is harder to observe. If you are living through this market, training this eye is the minimum you need to learn. Not to predict every movement, and not to defeat every candle. But so you are not guided only by the emotion of the moment. Many will look at these lines and become afraid and give up. Others will make bets without even realizing they are betting. But lines exist to give the market a place to confess. A line can break or hold. Neither tells us much by itself. If you do not understand the behavior of other people, it will be difficult to understand your own. And in the market, those who do not understand their own behavior often call luck a strategy.